Exam techniques and some of the more challenging topics. Always begin by considering and noting if you are dealing with a close company. If it's a close company, interest paid on loans used to purchase shares in the company or loaned money to the company by a controlling shareholder, holding more than a 5% stake, is deductible when arriving at personal net income. This is known as qualified loan interest. If the close company has issued a loan to a participator, a passive investor, the company must remit 32.5% of the loan amount to HMRC within 9 months and 1 day after the end of the accounting period. However, this payment is exempted if the participator has been working full-time for the company, the loan amount does not exceed £15,000, and, collectively with their associates, they do not own more than 5% of the company. HMRC will reimburse the remitted amount once the loan is repaid by the participator or waived by the company. However, HMRC repayment will only occur 9 months after the end of the accounting period in which the loan is repaid or waived. Considerations when acquiring the trade and assets of a company instead of all its shares. Capital and trade losses will remain with the original company. Capital losses can be utilized against chargeable gains from selling the asset, while trade losses can be applied against capital allowance balancing charges and any remaining chargeable gains from the sale. It's also feasible to transfer trading losses, but the same legal entity must beneficially own at least 75% of the business before and after the sale. For instance, by forming a subsidiary and selling the trade to it, the person is no longer the legal owner of the trade but remains the beneficial owner. In this scenario, losses can be transferred to the new company along with the trade. If the new company is subsequently acquired, it constitutes a change in ownership. If there is a significant alteration in the nature or conduct of the acquirer's trade within 5 years, starting no more than 3 years before the acquisition, it may not carry forward losses beyond the date of the change of ownership. If a company wishes to establish an overseas manufacturing business, there are 2 distinct approaches. Option 1. Owned directly by the UK parent as an overseas permanent establishment. Option 2. Incorporate a new overseas subsidiary. Key considerations include whether an exemption election of the overseas permanent establishment has been made, potential tax savings concerning any losses incurred, the impact on the group's cash flow of increasing the number of 51% group companies if forming a subsidiary. It's important to note that a subsidiary would be a 51% group company, unlike a permanent establishment, affecting the quarterly installment threshold for payment on account, which accelerates future corporation tax payments. A permanent establishment is not a separate legal entity, it is an extension of the owning company. Profits and losses belong directly to the company. The UK company can elect to exclude profits and losses from all overseas permanent establishment from UK corporation tax, but the election is irrevocable and applies to all existing and future permanent establishment. The current position of the company and any future plans need to be carefully considered. If a permanent establishment exists without an election, losses from the permanent establishment can be offset against income and gains of that year. Once the permanent establishment becomes profitable, the company will be taxed both overseas and in the UK. However, double tax relief is available, even without a double tax treaty. The relief amount is the lower of the UK or foreign tax on the PE's profit. If the overseas tax is higher, then no additional UK corporation tax is payable. A subsidiary is a separate legal entity. A company incorporated overseas will be resident in that country provided it is not managed and controlled from the UK. Losses can be carried forward to use against future profits. Any dividends paid to the UK company will be exempt from UK corporation tax, but consideration must be given to whether controlled foreign company (CFC) charges would apply. Generally, a permanent establishment could be used if expected to incur initial losses, allowing offset against UK profits. However, the specific facts of the situation must be carefully considered. Using a subsidiary will not allow loss relief in the current year, but in the following years, it could save tax at a higher rate if the foreign country has a higher tax rate. Provided the group is willing to wait, with an impact on cash flow, a greater tax saving can be achieved using a subsidiary in that situation. When a UK resident company controls an overseas company, controlled foreign company, CFC, rules apply if 1. The overseas company is controlled, greater than 50% owned, by UK persons or entities. Although the CFC charge only applies to UK entities, not UK persons. 2. The company is resident overseas. 3. Dividends are repatriated to UK owners. 4. The overseas country has a lower tax rate than the UK. 5. Each UK entity, but not individuals, will be subject to the CFC charge if they own at least 25% of the foreign company. A foreign subsidiary will therefore fall within the definition of a CFC if the foreign country has a lower tax rate. We then need to consider if any exemptions apply, in which case there will be no CFC charge. 1. Low profit exemption. If the CFC has taxable total profit less than or equal to $500,000 and non-trading profit less than or equal to $50,000, both part of the condition must be satisfied to apply. 2. Low profit margin. If the accounting profit is less than or equal to 10% of allowable expenditure. 3. If the CFC is in an excluded territory country. 4. The overseas country has a tax rate that is at least 75% of the UK tax rate. 5. Exempt period. No CFC charge in the first 12 months of existence of the CFC. For companies to be in a capital gains group, for group relief of capital gains and losses, the direct holding needs to be 75%, but indirect holding for subsidiaries only needs to be 50%. This is different to the group relief group, for group loss relief, which requires effective interest of at least 75% for both immediate subsidiaries and subsidiaries. If a situation involves a capital gains group, consider the following. The possibility of deferral through rollover relief against the purchase of a qualifying asset by another group company. The possibility of transferring gains to another group company, keeping in mind the impact on cash flow. If selling a group company, consider the availability of substantial shareholding exemption, SSE. If SSE is not available, explore ways to avoid degrouping charges. When buying a company, be mindful of pre-entry capital losses. Within a capital gains group, transfer of chargeable assets at no gain no loss is automatic and requires no election. This also applies to intangible fixed assets. Companies can elect to transfer the whole or part of a chargeable gain or allowable capital loss of the current period. The group is treated as a single entity for the purpose of rollover relief. Gains on a qualifying business asset sold by one company can be rolled over when a qualifying business asset is purchased by another company within the gains group in the qualifying period. Companies resident overseas are included in a capital gains group, but advantages are restricted to UK resident companies and permanent establishments in the UK only. There is no need to transfer assets for tax planning purposes. The gain or loss can be transferred by submitting an election. The no gain no loss rule allows groups of companies to carry out commercial transactions, such as the transfer of assets or even entire trades from one to another, without incurring chargeable gains. This is akin to the rules for stamp duty or stamp duty land tax, although for stamp duties, the effective ownership required for non-directly held shares is 75% rather than 50%. Degrouping charges, an often overlooked aspect. When a parent company sells a subsidiary, causing the subsidiary to exit the capital gains group, it's crucial to conduct a review to identify all no gain no loss transfers within the preceding 6 years. These transfers may trigger degrouping charges if the asset is still owned by the departing member. the subsidiary should be treated as if it sold the asset for its market value at the time of the no-gain no-loss transfer, reduced by indexation allowance up to the date of the transfer or December 2017 if earlier. This gain is then added to the consideration, or if it's a loss, added to the cost, received by the parent company. Consequently, the parent may realize an increased or decreased chargeable gain upon the sale of the subsidiary. However, in many cases, the entire chargeable gain, including degrouping charges, will be exempt if the substantial shareholding exemption (SSE) is available. In such instances, any loss relief will also be denied. If SSE is not available, the subsidiary can sell the asset to a fellow group company before exiting the group and rent the asset for continued use if necessary. Alternatively, both the subsidiary and the company that made the no-gain no-loss transfer can be sold as a self-contained capital gains group unit. Cash flow considerations when transferring capital gains or losses within a capital gains group. Companies with augmented profits exceeding £1.5 million, adjusted by the number of 51% group companies, are obligated to pay corporation tax by installments. The group's cash flow can be enhanced by transferring capital gains from a company that must pay by installment to one that pays later, typically 9 months and 1 day after the end of the accounting period. However, it's important to note that the transferred gain will increase the profit of the recipient company, potentially pushing it above the quarterly installment threshold. Pre-entry capital losses restrictions. Capital losses of the target company are carried forward to the time they are required. They can only be utilized against gains arising from assets sold by the target company before its acquisition, assets owned by the target company at the time of acquisition, assets subsequently purchased by the target company from non-group companies for use in its trade. As a result, the group acquiring the target company cannot use the pre-entry losses to offset gains on group assets. When dealing with 51% group companies, pay attention to the length of the accounting period. All companies in the group relief group will be considered 51% group companies. However, there may be others where the effective ownership is 51% but less than 75%. Also, remember to count overseas resident companies. Ensure that 51% group companies are included on the last day of the preceding accounting period, not just the current period. Consider the substantial shareholding exemption (SSE) before calculating any chargeable gains or allowable losses. SSE exempts any gains arising from the sale of shares but also denies relief for any loss. The relevant factor is not the percentage of shares sold but the percentage holding prior to the sale. SSE is granted automatically under certain conditions. 1. The company being sold must be a trading company or the holding company of a trading group. 2. The selling company, C, must have owned at least 10% for a continuous period of 12 months in the 6 years prior to the sale. This period can include times when assets owned by company, C, were used within a trade carried out by the group before being transferred to the company, C, being sold. 3. For instance, if a parent owns a subsidiary with numerous contingent liabilities, making it challenging to sell, the parent transfers the trade and assets of the subsidiary to a newly formed company, T, and finds a buyer for T. The transfer of assets to T is treated as no gain no loss, NGNL, as all entities are within a capital gains group. However, degrouping charges will apply as T leaves the group within 6 years of the NGNL transfer, which will be added to the consideration received by the parent upon the sale of T. Although the parent has not owned T for a 12-month period in the prior 6 years, SSE is available as assets owned by T have been used in a trade carried out by the group for the required period. When dealing with group loss relief, start by identifying the members of a group if multiple companies are involved. Determine the resident status of these companies and the location of any permanent establishment (SPE), as these factors influence how group losses can be distributed. It's crucial to consider any reliefs available within each company first before addressing group issues. Once a group relief group is established, several options become available. Companies can surrender current period losses, non-trading deficits on loan relationships, and any excess brought forward trading losses, which must first be deducted against their own profits. They can also surrender excess property business losses, excess management expenses, and excess gift aid donations to other group companies. The maximum claim by a group company is its taxable total profit, TTP, after deducting its own losses to the furthest extent possible, although different rules apply to losses before the 1st of April, 2017. There is a restriction on the amount of carried forward losses that can be offset for companies with profits exceeding £5 million. Companies resident overseas are included in a group, but losses can only be surrendered between UK resident companies or UK permanent establishment of overseas resident companies. Two key factors to consider when planning the distribution of losses are the amount of tax that can be saved and the timing. The amount of tax that can be saved remains constant as all companies pay corporation tax at the same rate unless double tax relief applies. Timing considerations involve identifying the ability to carry trading losses back after offsetting against the current period and deduct them from total profits in the previous 12 months. This enables losses to be relieved earlier than through group relief, which is advantageous for cash flow. A general group relief strategy involves reducing own augmented profit to the level of the quarterly payment threshold, then surrendering losses to other companies that have profits exceeding the threshold. Consortiums, leavers, and joiners of a group. In addition, think about the existence of a consortium when planning group loss. Not being in the 75% group doesn't necessarily mean loss surrender is impossible. It depends on who owns the remainder share capital. For instance, if 3 companies each own at least 5% of Company C, and Company P owns 60% of C, together they form a consortium company. In this scenario, P can surrender losses to C company up to a maximum of 60% of CS profit. It's crucial to be aware of any joiners or leavers to the group. If a company has been a member of the group for only 8 months, then only 8 months of losses profits will be available for group relief or can be relieved. A company joins a group upon acquisition. After acquiring the first company, the £1.5 million limit for quarterly instalments of corporation tax must be divided by 2. For the purpose of group relief, C is considered to have left a group when there are arrangements in force for it to depart the group, for example, an agreement reached subject to a contract being signed. There may be a gap between leaving one group and joining another. During this interim period, losses can only be relieved in the loss-making company itself. Losses may also be restricted under the new owner if there's a major change in the nature or conduct of the company's trade within 5 years, starting no more than 3 years before the change in ownership.